The Reserve Bank's latest forecasts are fueling debate over the path of interest rates, with productivity and inflation now firmly in the spotlight. Over in the US, fresh CPI data hiding some tricky details, sparking a muted market reaction that suggests traders may be ignoring the impact of tariffs. For more, let's head to Adelaide. We're joined by David Scott from StoneX. What stands out to you in the RBA's latest forecasts?
G'day, Aaron. Great to be back. Look, a few things really stood out to me. The first was just the pancake profile that it had for its unemployment assessments, 4.3%, where it currently sits out as far as the eye can see to the end of 2027, which is really unrealistic. It's got to be said in the broader scheme of things. We know the unemployment rate rarely is static for that period of time. And then a few other things. We also had inflation very, very steady as well, around target. And that was despite having one further rate cut underpinning those profiles. So we now have, according to the profiles, that these are all underpinned by the RBA, another 3 rate cuts beyond the one we saw yesterday. And so the RBA seems very complicit when it comes to cutting rates further at this point in time, which is a very, very different tone to what we saw earlier this year.
Very much so. What factors could change the current path of rates? And just explain this chart to us.
Yeah, so this is looking at what's called IB futures. So this is cash rate futures that are listed on the ASX, and it gives you a rough guide as to exactly what markets expect. This is pricing out to the middle of next year. And lo and behold, the RBA has got in its forecast 80 basis points, and it's got inflation at the midpoint of its target by the end of that profile. And so what have the markets done? They've got 80 basis points priced as well. So you'd imagine that given this timeline, we're probably going to get at least another rate cut in November this year. To me, the risk, though, is that it comes earlier and they go and bring forward easing, because we've seen the trajectory for unemployment here in Australia is clearly rising at this point in time. So I think its tolerance to seeing unemployment, say, with a 4.4, 4.5 will be very, very low. So that brings Thursday's jobs report front and centre for the minded traders and investors.
Yeah, I can imagine. And productivity as well. Why such a key focus right now?
Look, the productivity, when you looked at the SOMP, it had the most mentions in the Statement of Monetary Policy, more than inflation and way more than unemployment, which is really interesting. So that's the area of debate. The reason why it's so crucial is because they've downgraded their estimates for where trend growth is. So now seen at 2% per annum, productivity only at 0.7% on average. So what does that mean to the layperson? It means slower economic growth. It means the likelihood of slower wage growth. And it also makes the economy more sensitive to changes in interest rates. And that's where the kick is going to be, because if we start to go and see some rates coming through, some cuts coming through aggressively, that could go and lead to a re-acceleration in inflation. What we're looking at here is this. So just to explain the chart, we have the unemployment rate in black, and we've got youth unemployment, 15 to 24-year-olds in blue. And I want to include that because it's more sensitive to economic conditions. And you can see that we've seen a big spike in that particular measure over the course of the past couple of months. That is not a good sign for unemployment moving forward.
Yeah, very much so. Let's talk about what's happening in the US at the moment as well. Just break down the devil in the detail in US CPI.
Look, the market reaction last night was very enthusiastic, especially equities to the latest release. But so we saw a core reading, so basically stripping out energy and food prices of 0.3% month on month. That was the second fastest increase we've seen this year, and that left the annual rate at 3.1%, which is more than a full percentage point above the Fed's 2% target. But despite that, markets went and added to the rate cut bets because there wasn't a lot of evidence coming through of tariff impacts. So stripping out some of the detail, there's something called core goods prices, basically excludes energy and food prices. That was only at 0.2%. So the market rejoiced at that. But the really interesting thing is that what's called core services, which strips out housing, energy services prices, and that was what the market was fretting about, what the Fed was fretting about only a year or so ago, came in at 0.5% month on month and sits well above 3% per annum. That is a sign of strength in the US economy. It is not a sign of weakness, and it will make it very hard for the Fed to go and get inflation back to its 2% mandate. Yet that markets have got another rate cut priced in from the Fed next month, almost a lock, and we have another 4 priced in by the middle of next year.
Yeah, well, we'll see about that. It sounds like Jerome Powell has his work cut out for him if he can stay in the job. Always appreciate your insights, David Scott there from StoneX. Thank you.
Great to be here. Take care.